Welcome to today's Explainer. We are diving straight into a massive blind spot that is completely distorting Wall Street's entire view of the AI boom right now. On the surface, market indices look super healthy, right? But if you scratch just a little bit below the surface, there's a wild imbalance and, honestly, a total distortion of fundamental logic at play.
Think about this for a second. What if the market's absolute biggest AI winners are actually a massive trap? We're going to peel back the layers of all this hype today. We'll discover why the companies physically making the chips might actually be sitting inside a dangerously cyclical bubble. And on the flip side, we'll see why the tech giants who are currently footing the bill for all this infrastructure are historically undervalued.
Which brings us to part 1, the artificial intelligence market paradox. Let's get right into this completely bizarre situation where investors are just euphoric over hardware, but they're actively punishing the very companies paying for it.
Just think about the forward priced-earnings ratios for big tech right now. You've got Meta trading around 17, Microsoft at 21, Alphabet at 24, and Amazon at 26. For tech giants with utter, dominant market control, this isn't just cheap. It's honestly a historical anomaly. They're basically being priced like boring, legacy value stocks from the 1990s. It's like the market is acting as if their profit margins have been permanently destroyed.
And the root of this massive sell-off? It's Wall Street's absolute panic over capital expenditures. Investors are watching literally billions of dollars being thrown into the furnaces of data centers just to keep up in the AI race. And they are panic dumping the stock. But here is the massive blind spot they're missing. They are completely ignoring the fundamental physics of how this technology is actually going to evolve over time.
So, part 2. Who is paying for this banquet? To really wrap our heads around the sheer scale of this delusion, we've got to separate big tech's ultra-stable base revenues from their temporary AI spending.
Think about it. Meta and Google practically own global attention with ad revenue, right? And that's heavily insulated by the real economy. Mom-and-pop shops and medium businesses aren't going to stop buying targeted ads anytime soon. Meanwhile, Microsoft is literally the backbone of global corporate infrastructure. No company is suddenly canceling their Windows or Office subscriptions to save a few bucks. That cash flow is as reliable as gravity. Now, yes, they are spending an absolute fortune buying chips from Nvidia and memory from Micron. But while those chipmakers are swimming in big tech's cash right now, their revenue completely depends on big tech actually wanting to keep building new data centers forever. This leads us to part 3, the dead end of brute computing force. So why exactly does the world need so many massive power-hungry data centers right now anyway? Well, it all comes down to the current phase of AI development, and it happens to be a massive bottleneck.
We are currently stuck in what you could easily call the brute force phase of AI. The developer logic right now is super basic. You want to make AI smarter? Just shove petabytes of raw data into the models. The data cloud just keeps growing and growing. And to process all that in real time, models need way more memory, the fastest chips, and just an insane amount of electricity. But this brute force approach, it has a very hard, unavoidable physical and logical limit. And here is where the architectural madness really kicks in. The world's core fundamental knowledge, the laws of physics, classical literature, macroeconomics, that stuff is already loaded into these neural networks. The base is there. So why are the models getting so incredibly bloated? It's because they're vacuuming up the internet in real time. And let's be real, about 90% of that is useless informational garbage. We're talking endless chat logs, repetitive interactions, spam, daily news noise. Forcing these systems to keep all that junk in active memory is just architectural and economic insanity.
That brings us to part 4, the era of optimization, or what we'll call Gemini 5. Let's look at how this builds toward an inevitable breaking point when developers finally hit the ceiling of this bloated brute force method.
Let's run a quick logical stress test with a hypothetical future model. We'll call it Gemini 5. Eventually, developers will realize they just can't keep plugging in more servers forever. Development is going to have to pivot heavily toward optimization. Gemini 5 will analyze its massive raw data array, compress it into fundamental logical patterns and high-level concepts, and then it's just going to toss out that 90% of raw junk because it literally doesn't need it anymore. The system gets smarter through better logical connections, not just hoarding bytes. Suddenly, an AI that's been getting heavier and heavier for years becomes incredibly light, elegant, and efficient.
Moving to part 5, the hardware crash and Amazon's vulnerability. Because the second the industry shifts from just throwing hardware at the problem to actual software optimization, we're going to see a tectonic shift that will absolutely devastate the hardware market.
Here's the thing about chipmakers. They are incredibly cyclical businesses, and right now, they're operating at this artificially inflated peak. They've got massive profit margins because of the chip shortage, driving prices to the moon. Intoxicated by all this cash, they're pouring billions into building giant new factories all over the globe. But factories take years to build, so this creates a really dangerous capital lag. Millions of brand new chips are going to flood the market at the exact moment AI models actually slim down and need way less memory.
Big tech is going to wake up one day and realize, wait, we don't need to double our memory purchases this year. The data centers we already built are more than enough once we drop that 90% data bloat. The resulting crisis of overproduction is going to be brutal. Demand will just stall out, supply will absolutely skyrocket from all those new factors coming online, and memory and GPU prices will crash right back down to historical averages. Those wildly inflated multiples for companies like Nvidia and Micron, they're going to collapse as the market gets a very harsh reminder about technological cyclicity.
Now, within the big four tech giants, there is one major outlier here. Amazon is actually the most vulnerable link in this scenario. Why? Because Amazon Web Services, or AWS, operates on a totally different business model than the others. AWS is essentially a digital landlord. They build giant data centers and just rent out the raw computing space to other startups and corporations. Well, when the era of AI optimization hits, those clients will suddenly need way less server space to run their new, lighter models. Amazon's brand new, incredibly expensive data centers could become dangerously redundant, which would probably trigger massive price wars in cloud computing.
And that brings us to part 6, the golden age of the big four. For Google, Meta, and Microsoft, this exact same shift to lightweight AI is going to spark something unprecedented. We're talking a literal golden age of wealth accumulation.
Think about the stark divide this is going to create between the winners and the losers. For the winners, Google, Meta, and Microsoft, their ultra-stable base revenues stay completely untouched, but their biggest, most terrifying hardware expense, it just vanishes. All that cash they were shoveling into the furnaces of hardware manufacturers will suddenly just stay in-house. That means an explosive, stratospheric surge in free cash flow. But for the losers facing massive overcapacity, it's the exact opposite nightmare.
This is the exact moment Wall Street is going to finally wake up and realize its massive error. Investors will see that big tech basically used their own huge cash reserves to seamlessly build the infrastructure of the future, optimized it perfectly through software engineering, and turned themselves into even more efficient, unstoppable money-printing machines. Those low PE ratios we talked about earlier, they are essentially a historical gift that is currently disguised as a market panic. The investing crowd's absolute biggest mistake is assuming technological growth is just a simple, straight line. But there's a rule to remember. True progress always happens through qualitative changes and sharp turns, not linear extrapolation. People just project current trends infinitely into the future, and they completely miss the paradigm shift. Real progress happens through architectural perfection, data optimization, and sudden leaps, like instantly deleting 90% of a model's junk data to make it genius-level efficient.
So, the crucial question we all have to ask ourselves, especially while the current market hype is actively blinding the masses, is this. As this technological evolution takes its inevitable sharp turn, are you going to be caught holding the bag on highly cyclical, oversupplied hardware? Or are you going to capitalize on the ultimate, highly optimized evolution of big tech?